with the topic of the future of the industry, and also want to try and contain that, and perhaps our industry can be the alternative industry more than anything else. Perhaps from the point of view of where we started, and maybe Peter, starting with you, what do you feel, specifically politically, I thought what you said earlier was very interesting, but what do you feel there are any trends over the last 2 years that have affected the industry? You've told me that you're involved in private equity, so you're in the space. Do you see more activities than 2 years ago? Do you see a trend, any development, any changes geographically as well as to where the activities seems to be concentrating?
No, look, I think I'm not a manager of a fund or of assets, so I focus basically on private investments together with friends here in Switzerland in a particular area. So I'm not really a good connoisseur of the whole trends. I think if I would see one trend, then it's certainly a we see a lot of opportunistic things going on, and that a lot of people go out of their traditional way to invest. You see private equity firms doing things which they never would have done before the crisis and so on, because it is simply very, very difficult to find appropriate clear investment opportunities outside of the things which we have seen by Mr. Dr. Frost this morning, or the hedge fund industry, and in between you see a lot of opportunistic things. That's what I
You were talking about lending earlier and cross-border lending, and we've seen quite a lot of so-called alternative funds participate in the financing.
That's what I would think is an opportunistic thing. I think in the long term, you can't run these economies by hedge fund going in and do some of this lending. I think you need banks. That's what I say with opportunistic plays.
So moving to the private bank, perhaps Juerg, when you're considering what you're offering to your clients, what do you feel the industry is doing better than 2 years ago, or is the alternative still a secluded sector in terms of what you want to be offering? Have you seen a pattern there that's developed?
I think, first of all, the private client or the private banks, they are under heavy pressure with all these issues going on. And so they have to concentrate on solving these issues. But second, what I see, maybe in addition what you said, in regard of what the investors are looking for, they are somehow skeptical about the fixed income class, because the risk of increase of interest rates is here. And there is another group which is even so skeptical that regarding the currency systems might produce a problem somewhere in the future with all this money printing going on and this debts increasing on governmental levels. And so what they are looking for is somehow real assets and steady free cash flow. And this you can find in opportunistic phase, as you said. I think that is one of the main trends we see.
But would you go there? Isn't that too risky for your clients and your advisory services?
I mean, this is a very opportunistic investment. What we have done lately is to invest in the European train system, actually buying goods wagons of trains and leasing them out to Royal Dutch Shell and Holcim and so on. But this is very opportunistic, of course.
I do think it's an interesting element that we heard this morning property described as a totally safe investment equivalent to Swiss government bonds, but with a higher yield. But there we have people opportunistically going into long-term infrastructure products, and certainly around the world, it's amazing how often I speak to pension funds who are pushing out into things that they think of as having a steady coupon, but what they're doing to get that is taking an enormous amount of illiquidity risk. And it seems to me, while the next illiquidity crisis isn't going to be like the last one, when we have a world where reasonably every government is desperate to find a new way of raising taxes. The idea that the yield on an infrastructure project is completely secure seems rather strange to me. It may not be that you're forced to liquidate it, but it might well be, and I think it will be, the case that governments, the moment it looks like the yields on those are actually delivering something attractive, will start taxing them much more heavily.
I mean, I certainly had a conversation with the National Bank of Holland about 2 years ago, because all the pension funds there were relatively aggressive in venturing into infrastructure projects. And I certainly see the risks of that area as massive, valuation risks, clearly liquidity, who you're dealing with, how do you monitor such a risk, legal risks, because there's plenty of that around all the documentation. Luke, so I was going to come on to you in terms of your position. You're the most alternative of our panelists here.
Should I take my jacket?
But man developing into real estate or infrastructure to take those opportunities on, or sticking to liquid alternative investments?
No, I mean, I think, look, our expertise is in the liquid environment. That's my background. So it's certainly where I feel most comfortable. And I think the skills needed to look at an infrastructure project, there are absolutely some which are great investments, but the skills needed are significant and different compared to what it needs to understand markets or stocks over the next 1 week to 1 year. So I suspect we'll stick to the piece that we understand.
Any specific, I mean, you were saying earlier, I think it was you, that it's very hard to sort of take a stake on whether global macro or long-short equity or long-short equity America will be the next thing to go into. Any futures have been a big story because sometimes they do well, sometimes they do less well. They're usually decorrelated. Any specific views as to how, not necessarily your firm, but your peers would or might seek to evolve?
Well, I think the industry naturally evolves by chasing the thing that's worked most recently. So, US long short is the thing that everybody loves because it's been making money, because most of them have a beta of sort of 50 or 60% to the US equity market, and US equities up. I think, to the question I was asked earlier, one of the biggest thing about fees is you shouldn't ever pay 2 and 20 for beta. Beta is something that by definition should be cheap. So when you look around at alpha opportunities, I think that actually we've seen a lot of decorrelation of individual stocks and credits. So sort of fairly boring stock picking or credit picking is pretty attractive at the moment. It's producing good returns and no great reason to see it going away. To get good returns in macro and CTAs, for that matter, basically requires economies to decorrelate. So the issue at the moment is basically fixed income is all going up and down based on what the Fed says in 5 hours. You don't get any diversification in a macro thing, and so it ends up being one bet. And then it's not that's not the time the strategy is at its best.
But what amazes me with the alternative space is that I've never felt that people were really selecting it as anything separate to an asset class almost. I mean, earlier some of your statistics talked about hedge funds, and I wondered in my mind, what hedge funds? And now we see that some hedge funds are lending money, so are they still qualified as hedge funds in that data? And it took me to the idea that I think you were touching on, that at the end of the day, a lot of the way that we've gone about portfolio management, so I hear about the opportunities, the niche, the infrastructure, but a lot of that is done still on the basis of returns and not necessarily on the basis of understanding the fundamental of what drives that return, be it operations, be it know-how, be it innovation. Maybe going back to you, Juerg, have you built up your capacity to research those type of investments so that when you offer them, you have more security than that might let you sleep at night? I mean, I think you're an unlimited partner in your firm.
Yes, I am, and I'm still laughing about the risk is increasing because of this legal uncertainty you mentioned before. This is we have to take that serious. But what you say, yes, it's of course very important that you do the due diligence and the operations have a proper setup. In the end, I do not think that there is a large correlation between a proper setup and the investment results in the end. I do not agree there. I think the operational side might be important when it's concerned regarding beta plays. But on the alpha side, of course, it's important that the operations are well set up, but for the long-term alpha performance, this is not the key issue.
That's very interesting. Maybe I take that and you know, trying to make everyone participate, even our tax friends.
Thank you.
He just takes 25% of whatever we have.
I feel somewhat bad now.
But Jochen, I mean, okay, so it's good. We've got some disagreement here as to the importance of investment selection, potentially. You see the tax risk. You were talking about it earlier. I mean, I fear the tax harmonization. I've touched on that because I think it sort of creates a very common market where whoever decides the tax rate isn't necessarily the best person to decide it for everybody. So I like the competition. The tax risk of an operation that an infrastructure project dealing with trains, I don't know if you've come across it. I mean, I'm not an expert on that, but I'm sure there is one. And therefore, do you feel that in the requests that are made out of your services, are some of them specifically related to investment due diligence, as in, you know, operational due diligence ahead of an investment, more than, say, before 2008? And do you think it's relevant because you yourself, you wouldn't put money into an investment like that because you understand the tax risk perhaps better than another?
Yeah. As I said, I'm feeling a little bit bad now because Juerg and Luke are talking about making money. I'm only talking about spending money now. Yes, I think there is a risk component in every decision that, as I said this morning, that a client relationship manager or portfolio manager does. I think the banks need to revamp or ramp up their capabilities of finding what is the right tax position for a client. I think in no event can a bank tell this particular product which I'm offering to a client is tax optimized, because a bank never knows the entire position of a client. Client may have bank accounts with bank A, bank B, and bank C, and the only person knowing how to concentrate this entire information is the personal tax advisor. So I think a bank can only do something like mitigating the risk in order to prevent putting any kind of product into the portfolio that could cause a catastrophe, a tax catastrophe with the client. So I think many banks are currently thinking about putting together some sort of tax suitability handbooks, whereby they say these products are red flagged for the client, so please don't put them into the portfolio. These products are amber flagged, so you should consult your tax advisor, and these products are green in that they don't cause any kind of negative ramifications. So I think most of the banking industry is trying to tackle this problem from the negative side rather from the positive side. Because if I recommend a product, if I'm looking at it from the positive side and tell the client you should put this into the portfolio, you are accepting a kind of inherent guarantee for tax suitability.
So more complications there. Sticking to tax. Peter, you seem to have some I think interesting political views. Do you worry about a tax harmonization? Do you prefer tax competition across states? Do you think that would make the environment or the economy better or stronger?
Yeah, I think we know by experience that tax competition keeps taxes lower, and we see it here in Switzerland that the fact that there is tax competition between, let's say, Geneva and Schweiz here has traditionally kept taxes low, and it is the leftish parties who basically always want to have tax harmonization. The same obviously applies on an international level. However, since a number of years, and this started already far before the 2007-2008 crisis. Governments, in particular here in Europe, got what I called impoverished. They had not sufficient money. And actually, I wrote an article on legal risk management back, I think, in 2003 or 2004. and I had a risk radar there, and in the top right corner, which is highest concern, etc., I put in impoverished governments. And this is really the story which has happened, because the governments have now become very, very aggressive to expand the tax basis, to fill loopholes, to go after people who don't pay taxes. And they have realized that the real problem is that we have different jurisdictions, because there are always places people can hide a little. And so that's the background of this FATCA, which you have shown. But this is the first step. The second step is obviously harmonization. And you see in the EU there is a lot of talk about tax harmonization. They have harmonized more the indirect taxes, but there is certainly political pressure to harmonize the direct taxes. And I think if this comes about, a theoretical world which would have a common view on tax rates and a common view on tax base, would immediately lead to much higher taxes, if in this theoretical world. Because, we shouldn't fool ourselves. All these things are very, very simple. The politicians love to spend the money of other people, and because then they can go into the pet projects. And look what happens with the VAT in Europe. And we could hold the tide here, but in Europe, whenever they have new pet projects, they go up with the VAT, and there are countries where you pay 20% of the VAT. So I think this was the long speech. And the short conclusion is tax harmonization is really bad. We would all end up with 60–70% effective tax. You are laughing. You were a boy in England. That was reality.
Look, we had 97% marginal tax at one point, and having been there, the one thing I could say is, in a tax harmonized EU, you won't have the UK in it. With due deference to the politician in the room, and I think the bit that comes on tax harmonization is, people assume it's just about the tax rate, but it's so important as to exactly what it applies to and how it's collected. And, it remains Europe's #1 problem that, we either have to have a transfer of money from Germany to Southern Europe, or else somebody from Germany needs to turn up in Southern Europe and make people pay more taxes. They don't need to increase the tax rates, they just need to increase the tax take. Now, you could choose which of those you think is less palatable, but honestly, I suspect that the answer is it's money getting transferred down. But anyway, yes. It's not even a political view. I just don't believe the UK would ever vote to be part of a tax-harmonized Europe.
I think the ugly thing with harmonized taxes is it's a kind of inherent ratchet system, because if they go up, they never will go down again. I mean, you can see that at a very good example in Germany with the solidarity surcharge. Now that the East Germany has been financed, or should have been financed, we would have expected that at some level the solidarity surcharge is going to be abandoned, which it will never be, probably.
In that context, I mean, even England risks changing in 2015 and whatever election after that. But Luke, where do you, you're obviously you've got a place of business here. Where do you, when you look at the world, your developments, you're a multi-billion company selling across the globe. What's potentially next? What's in your radar?
I think one of the interesting things is there's a set of people, there's a set of processes which you have to have in the right place for those processes. So the answer is, the reason we have an operation here is because we cover German, Swiss clients from here, we trade German and Swiss markets from here, and we have several German or Swiss portfolio managers who don't want to live in London and would rather live here. Those things naturally fit here. We then take advantage, or I don't know what the official term is, of the tax rates, but in the differential between here and the UK, in order to, that affects the way you book things. But the big question of where you then employ everybody else really comes down to where you can get high-quality labor at a very good price. And in a technology world that we all live in today, you don't need the people who do your middle office to sit next to you. You don't need the people that do your programming to sit next to you. They could sit reasonably anywhere. And so I think the competition has to be much smarter than just, we've got a lower tax rate. You know, the answer is Malta's got a lower tax rate. You can book business in Malta if you want to book business in Malta, but you haven't achieved anything apart from to fund a couple of monkeys. It seems to me that too often it becomes about competing on, well, it's one of those. They're all the same sort of
I think you meant
ex-English islands.
I think you meant palm trees.
Yeah, it's one of
Palm trees.
Much more politically correct. Touching further on this, perhaps, Juerg, you know, you're obviously a private banker. I was just in Singapore, lots of private banking activity taking on place there. It's no secret that a lot of Swiss banking activity is now based there. You're more local, you're talking about Germany as well, so I guess you got your anchors. Do you feel that some of your clients are saying, well, I mean, we had those charts about declared, undeclared money, clearly a big topic across the globe. Do you feel that you might lose out because you're in Europe or exposed by being in the EEA to other competitors who have the facilities to move abroad and maybe those countries are now on the receiving end of assets?
I think this is a trend going on, and of course the new rich people, they become more and more in the Asian and growing markets, and that's for they have somehow a need for private banking services. And private banking is typically a model which is somehow also not too far away from a client. And that's why I think, of course, Singapore and Hong Kong and places like that, they have quite a good future ahead of them because of this reason. What our company is concerned, we are a boutique, we are small. I think we are a small fish in a big pond still in Switzerland and Germany. And for us, we concentrate on the business here. What the client base is concerned, what the investment side is concerned, this is a different issue. So, of course, we are traveling also through the world and look for good opportunities.
Joachim, going to you, maybe a controversial question, but those people who have set up in different parts of the world with Panamanian companies, which may have been more of a norm here, which is more concern I hear, or I understand that now they're contemplating the globe, and you know, Hong Kong is China, so that may not be good. Switzerland is too close to EU, so that may not be good. And Singapore comes up again, or you know, other destinations, New Zealand for trust work. Do they come and ask you, or have you seen a trend in more questions being asked about how do I achieve this legally, either by going back to transparency, but in a jurisdiction which is further afield, so it suits them, or just by maintaining the status quo? I'm sure it's all legitimate, but do you see a trend in being, or in Ernst & Young receiving that kind of questions?
I think if you're talking about the status quo as undeclared monies, I don't think there is a big future in that. Because once we have automatic exchange of information, I think it gets very, very difficult to really hide money and dodge on taxes. From that perspective, I can also understand the calculus, the political calculus in Switzerland saying we have moved our position diametrically from opposing to exchange of information to going to exchange of information, and we want to bring ourselves into the development of the kind of standard of exchange of information, because the more countries apply the automatic exchange of information, the more leveled the playing field is, and the less likely it will be that somebody thinks about moving his or her assets from Switzerland to Singapore, if Singapore also applies a kind of automatic exchange of information. So what remains is places like, I probably know, Vanuatu or something like that. Honestly, I wouldn't know if I want to have my money administered by somebody in Vanuatu.
Fair enough, but doesn't that, I mean, Peter, I don't know if you're going to speak, I thought you might, but exchange leads to disclosure, leads to harmonization, leads to, you know, global controls. Too far?
No, I think I would fully agree with Hans-Joachim. You know, the world of this cross-border business where the banker didn't look whether or not the money is tax taxed back home is gone. You know, this is simply a question of further developments. But that's not what when I talk one should, fight against tax harmonization, I meant other things. It's tax rates and, tax base, which you mentioned. These are two different things. This is really gone. If I want to add, I think the Swiss banking industry will survive it well. There will be, it will shrink a little. I always said it's 10 to 15%, but we can live with it. There are other seismic shifts which are much more important. I think they have been mentioned by Juerg. For me, the key problem is that Europe is such a weak area in the world. Europe is really the loser of this whole thing. And you have only to know 3 numbers to know what is going to happen with Europe. In Europe, we still have 25% of the GDP economic, but only 8% of the people live here. But on top of it, 50% of all social security and social aid is distributed here in Europe. So if you take these 3 numbers together, you will see what's going to happen. The 25% will adjust to the 8%. There is no money left to support the 50%, and we will have social unrest. We only have seen the beginning of this. And on top of this, Europe has no strong institutions to cope with it. It's the EU in many respects is a wonderful design and a good peace project, but it's just too weak to cope with it, and they even don't see the problems. European banks would need probably 3 trillion additional capital in this new world. But the official policy of the EU is that I think 80 billion is sufficient. So we are talking about the factor of 25. And so, and if Europe will go down, 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 and down in relation to other areas, and this is the most likely scenario in my view, this will have a very serious impact on our industry. And I think you have mentioned this, because then people, the wealth will all go to the Far East, and they will not travel to Zurich. But I would want to conclude on a more optimistic note. I've read, and this tells you everything about scenario thinking, in a book by Ulrich Beck, and that's basically the guy you have to read if you want to understand these things, that due to climate change, London, Tokyo, and New York will be flooded sooner or later. And this is really good news for Switzerland, because Zurich and Geneva will not be flooded.
Well, I can see that it's 21 past, so...
you could carry on, but I've got a plane.
We shall say goodbye to Luke. And
Thank you all, everybody.
Just finish off on one last point. I did notice that our European ambassador was taking notes, so I hope that will be of some help. I was going to ask Luke whether any of his managers had bought farms in New Zealand, talking about social unrest, but we shall not be able to answer that question. There you go. So, Luke, a case in point of what I said earlier, the farmer in New Zealand. We can all go and stay there when we face social unrest. Just to conclude then, therefore, compliance, the burden is large. I think compliance is a misnomer, because we talk about regulations, which deserves compliance. We talk about due diligence, which deserves compliance. We talk about tax, which deserves compliance. All of these things really necessitate a system or a process. It seems to be huge. It's at all of the levels of the industry. Is it workable? Can we do business with it, each of you? So starting with Jochen.
I think we can, however, not under the market parameter that we are working now. Probably, as I said, there will be some mergers of smaller companies who can't shoulder the compliance cost. Maybe there will be some outsourcing of compliance functions to specialized companies. I think in the future, when I open a bank account, I will probably not have a bank account opening form, but a bank account opening book. But as long as this data is collected once, I do not feel hassled as a customer.
Okay, Juerg?
I
I think, yes, we can, but it's necessary that you decide in which markets you want to be active and that you focus on these markets. I just met a colleague last week, and he told me the bank is not much bigger than we are, and he told me that they have clients from around 150 different jurisdictions, and this is, by compliance, this is not possible to handle anymore.
I mean, I understand on private banking in particular, the burden and the costs are very important. And notwithstanding, I know you were a member of a larger bank in the past, they seem to, in my view, and I can't understand it, make some faux pas when it comes to even the basics of AML checks, and not just that bank, but many banks. I mean, it's millions of penalties across the globe. I don't understand why that happens. You're in an institution which is probably easier to control. Is that an area of increasing cost? I mean, if you had to go from 2 staff to 10 staff on the sort of...
Because we were always focused, we actually don't have, and we were also living the outsourcing concept since the beginning, and so we can share increasing IT investments which are necessary to handle FATCA, for example. And so we are, if I compare, in quite a comfortable position at the moment.
So, Peter, workable?
Yeah, I think definitively. First of all, it's no option. If you think non-compliance is the better route, then go to it, and you will see it's no option. It must work, but it's one of the reasons why I said institutions have to become smaller and have to invest more in technology and smart systems. Because our problem at UBS was our systems were quite good, and we had a very strong intention to have a good compliance, but we were simply too big. And you see now what's happening to JP Morgan. It's a repetition of the UBS story, just on a much higher level. Jamie Dimon is now faced with 6 billion. That's a figure even I have never seen. And I think smaller institutions like Juerg are better a customer for strategic reasons, and that is the notion for the future. You have to get compliance strategically under control to get your institution to the right size so that the top management really understands the business where you are in. And then once you have established that on the strategic level, you make an operational model and you put as much technology into it as you can, or you make an LPO, a legal process outsourcing, and keep down. And I think we have to do it, and we will be able to do it like the oil industry and the drug industry. It is expensive. I said overall 10% of GDP these days goes in compliance, and the banking industry is only a very small part of it.
Okay, well, I think that's very interesting and should conclude our debate. I always like to note that the regulations of the airline industry is obviously huge, and that's to avoid them falling from the sky. And there's 100,000 flights a day, and lots of companies making profits. So that must be good news.
They don't make profit. The airline industry never has made
If you join me in thanking our panel, so Peter Kurer from VLR, Juerg Staub from Reichmuth & Co., and Jochen Jaeger from Ernst & Young. Thank you very much. So now we'll break for coffee, and we'll see you 15 minutes break for coffee. So if you could be back here at 22, that would be wonderful.